Mechanics of a deferred exchange. If you've never done a 1031 exchange, it might help if we provide you with an overview of what you can expect, as well as a couple of suggestions which might make your exchange progress a little more smoothly. First off, before you even consider an exchange, determine whether you and your property qualify to be exchanged pursuant to Internal Revenue Code Section 1031. Specifically, is your property, as well as whatever property you expect to acquire, going to be considered like kind for tax purposes? Meaning, are you holding it for investment or are you holding it for income? Make sure it is one of the two, because those are the only categories for what is considered like kind. Then, ascertain what your capital gain is likely to be, as well as your equity. This will give you an insight into how expensive or how much of a property you will need to purchase as a replacement in order to defer as much gain as possible. If you need a quick primer on gain and equity, equity is the amount of property you own, essentially the net selling price minus whatever debt you have against the property. To determine capital gain will require knowing your cost basis in the property. Here's a quick calculation for that. Take your original purchase price plus any improvements you've done to the property minus any depreciation, and that will be your basis. So subtract your cost basis from your net selling price, and that amount should be very close to your capital gain. Now, as you prepare to sell your relinquished property, don't forget to include some language which memorializes your intent to complete an exchange in your listing agreement. This is also language you should include in any purchase and sale agreements as well. You should want to include this language so you can enlist the assistance or cooperation of the other parties in your transaction. And if you're not sure exactly the language you use, just use buyer agrees to cooperate in a Section 1031 tax deferred exchange at no expense to buyer. That should work. Then, before you close, secure a qualified intermediary facilitator who can provide the necessary professional exchange assistance and who can ensure your funds, after they arrive from the closing, will be deposited safely. That's critical. Also, remember to avoid constructive receipt issues. It's very important to understand that you cannot touch or control those funds during the entire exchange process. Now, because the market is so hot in some areas right now, I'm going to encourage you to start looking for replacement properties even before your relinquished property closes. That 45-day identification period moves very quickly. Then, once you've located suitable replacement candidates, identify them appropriately using the identification rules, usually to your facilitator but not always, and make sure the identification has been successfully received. Remember, most exchanges that do fail because of irregularities in identification, so any extra care you exhibit within that effort is going to be time well spent. Okay, we're coming to the end here. So, you line up your replacement property financing, if any, and before closing, contact your facilitator so they can put together the documentation necessary which will tie any replacement acquisition into the overall exchange. And make sure you're getting all of this done within the total 180-day exchange period. Don't forget then, if you started your exchange late in the calendar year, you may actually need to file an extension on your tax return to get the full 180 days before your tax return is due. Then lastly, go ahead and close on that replacement property, and then fill out that Form 8824 and file it with your regular tax return. And those are the mechanics of a standard deferred or delayed exchange.